So the consumers and the savers, they're being squeezed from two sides. On the one hand, you've got inflation, prices going up, and on the other hand, you've got yields going down. So they are effectively paying for the speculators.
Well said, Valentin. I couldn't have said it better.
Great. Thank you. Just sometimes I'd like to take the opportunity to, when I speak to people like you, to confirm my own theories. What can a saver do in terms of investment, in terms of saving for retirement, in terms of protecting his capital?
Well, there are so-called businessman's risks. These are investments in real estate investment trusts, for example, mortgage-backed real estate investment trust, in business development companies, in other finance companies that through a relatively small amount and prudently managed amount of leverage can generate returns upwards of 5 and 6 and 7% for savers. But those yields do come with some risk. They come with a risk of a change in what we call on Wall Street the shape of the yield curve, that is the alignment of interest rates over time. They come with credit risk. They are not for free by any means. So what it means for a saver is to generate a kind of a living level of income that comes with a certain amount of apprehension.
What about stocks?
Well, stocks don't yield very much. Stocks have been on the upswing since March 2009. It's been a lovely bull market, but the consequence of all these years of appreciation is that valuations are relatively high. They're relatively high with respect to revenues, with respect to earnings, and with respect to book value, and with respect to dividends. So stocks may or may not be near a top. I've learned in the fullness of years not to say that, not to assert that they are. But in any case, they are no longer cheap.
I mean, let's be fair, like you say, all the longer-term valuation indicators like the Schiller PE, the stock market value to GDP, they are at red-hot levels. But you have also said that this monetary policy has never been around, so it makes it hard to predict.
Yeah, we certainly have had long experience, we and our forebears, with ultra-low interest rates. Interest rates in this country and in many other countries were very, very low in the 1930s, 1940s, into the 50s. They were very low in the Victorian age in Europe and Great Britain. But never before have, at least as I know financial history, never before have these ultra-low interest rates coincided with muscular attempts by the monetary authorities to lift asset prices, lift stock prices and bond prices. So in the 1940s in America, interest rates were just as low, or almost as low as they are now. What was different is that the Federal Reserve was imposing higher margin requirements to stifle speculation. Now the Federal Reserve is fanning speculation. And it's a very, very big difference, and it's a difference that I think very few people understand or appreciate.
So can you entertain us with explaining the famous wealth effect that the Fed always...
Yes, wealth effect.
Yes.
The idea is, this is a very fancy concept. I'm not sure if mere mortal human beings are capable of understanding it. But as posited by the scholars at the Fed, the portfolio balance channel, if you please, Valentin, the portfolio balance channel is a technique by which people are led to consume more by dint of owning more. See, if the stock market goes up, they will feel richer, and they go out and take the missus to dinner and a movie. That's the idea.
So, to my view, isn't that sort of a circular or backward logic? If you actually wanted to consume, you'd have to sell the stuff you own?
Yes, right. Well, I think the idea is that you feel so smart and so wealthy by dint of appreciating asset prices that you are led to live in a larger with more consumption the other way. I mean, I think the empirical evidence for this wealth effect is very, very slight, and I've read some very persuasive things saying it doesn't exist. In any case, insofar as it has contributed to this country's well-being, it has contributed to the well-being of the people who didn't really need the contribution. It has done very well for the rich.
Okay, what about...
especially the deserving rich, I guess, yes.
What about the low rates, to finish that chapter off, and the return of capital in the overall economy? Do you have an opinion on that?
Could you rephrase the question?
So what I heard, I'm just going to tell you what I heard, is that, and I would like to have your opinion on that. So if you have very low interest rates, like in Japan or in the United States, isn't that ultimately a sign that the economy is not able to actually generate higher returns?
Yes, yeah. It speaks to a sterility of capital. If capital yields nothing, which is what it does these days at the short end of the yield curve, what does that say about commercial opportunities and returns to invested capital?
And just real quick, why are they so low in real terms?
Well, one can't be sure. I suspect that a great deal of it has to do with not only the policies of the central banks, but also the psychology that these policies have inculcated. There's been all this talk about deflation and near depression and crisis. It's been 6 years, and it seems to me that the Fed has done us no favor by keeping alive this idea that we are in a perennial crisis, a new normal. I dispute that.
Okay, so going back, we're going to switch back a bit. You talked about real estate before. What's your opinion on New York real estate, which is going absolutely crazy as we speak here?
Yes, I will borrow from my interlocutor. It's crazy.
So
it's like real estate in London. It's like real estate in Geneva. It's like real estate in many places. It's seen as a safe haven. People, I think, have a latent, if unexpressed, suspicion of these monetary policies. They can't put their finger on it, but something is fishy. So when they create this money from nothing, trillions of dollars, conjured as a magician might conjure something out of a top hat. So if the cost of production is nothing, isn't that the value of this thing? I mean, don't commodities revert to the cost of production? So if money is for free, shouldn't one hold something tangible? I think that's at the bottom of a lot of the action in real estate. People want to be in a safe city. They want to be they want to own something that they can look at and they can kick as they walk by it in the morning.
But I mean, let's be fair. During the last crisis, New York real estate, at least the common-sized units, barely went down.
See, what's the expression? I think past performance is no guarantee of future results.
So you do at least see the possibility of also New York real estate?
Oh, sure. I mean, there's plenty of real estate. I mean, in this country, there was, as you no doubt recall, there was a coast-to-coast collapse in residential real estate values. In the late 1980s into early 1990s, there was a positive crisis in commercial real estate.
Including New York? Including
New York.
Okay.
Buildings in this 120 Broadway, which is just up the street here, went broke. An American ancient building from 1910 or 1912. There was distress in Dallas. No commercial bank in Texas, no indigenous commercial bank in Texas did not go broke, except for one. I guess Cullen Bank didn't go broke, but the commercial real estate crisis of the late 1980s was responsible for the loss of hundreds of billions of dollars in capital savings and loan industry. So when you bid up the price, suppress the we call the cap rate, the yield on these income-producing buildings, you are inviting trouble eventually.